it's tailored to companies in the same industry. I talked about this yesterday, but you're seeing good results in the same industry and companies reporting bad results within the same industry. Something I talked about, which you're not used to seeing in the past. But, we got to start off, I guess, with Target.
Yeah.
That's the story today.
Yeah, I mean, Walmart blew it out. Last year, they reported good earnings. They beat them this year. Target was the opposite. They earned $3.03 in earnings per share last year. They reported $1.54 today, down from the consensus of $2.18, Frank. Yeah, to your point, you're betting the jockey, not the horse. Management teams are kind of rising to the top there. To go with the macro theme, you and I were talking about this. This makes sense because consumers are getting squeezed by inflation, so they're looking for value, cheaper. That's a big tailwind for Walmart versus Target, which is, a higher tier, a higher quality, a higher price point. And you said it best. You're like, a lot of this is just common sense, man. Things are hard and people are going to go where it's cheaper in value. That leads to Walmart over Target because of their grocery exposure and because consumer behavior is changing. They said in the last week of the quarter that consumer sentiment can change significantly. Mm-hmm. That's, to your point, when you have major corporations like FedEx, Targets, and all this warning, you got to take note. That just means there's rougher times ahead in markets and economies in general.
It's going to get worse, right? I mean, rates are going higher. Like I said, you have this big pile of cash that people have. It's getting smaller and smaller and smaller as costs go higher and higher and higher. And this, this delusion that the Fed, they're going to pivot. They're not going to lower rates anytime soon. Even if they stop, even if they slow, even if it goes to 4.5, 4.5 the entire year next year. You don't know what that is going to do and the impact it's going to have on earnings, and you're seeing it. But Target compared to Walmart, and you mentioned something good when a lot of times this comes to common sense, where we can analyze the numbers, we can look at everything, but let's take a step back, right? Because when you look at the numbers, they're terrible. They missed by 60 cents. Earnings per share are down 50% year over year. Massive. They saw strength in food and beverage, which is huge, and it makes sense, right? Because groceries are getting much more expensive. So, you're going to go to Target, you're going to go to Walmart. But the costs were much, much higher here, which were unexpected. Margins got hurt. EBIT in this earnings before interest taxes, not to get too technical here, but it's a cleaner version with margins. They're expecting 3% compared to 6%. In margins, if that was earnings, that's like missing earnings by like 70%. That's you see people when companies miss on margins. They put in basis points because usually it's so small. They don't say you miss by a percentage because you usually don't miss by a percentage. You miss, it's in basis points. To miss by 3% is insane. Or to say that that's what's going to be going forward means that they have a lot of inventory, which they do. But they said specifically on the call that in October, sales starting trending lower, got worse in November, and now they're warning, like you said, in December. So what did Walmart do differently? One is that Walmart caters to a lower end consumer, and Target's like right in the middle. I always argue like, wow, Target's just weird. They're just like right in the middle where it's like, you wouldn't call it high end, but it's like, I don't want to go to Walmart. I'd rather go to Target, and just like, whatever. But their prices are definitely higher. So what's happening with Walmart where people are like, okay, I'm going to go buy my groceries there now because they're a lot cheaper. And sometimes they have quality issues in terms of, how they rank them in certain surveys or whatever, but the bottom line is they're going there, they're saving money. And when you're the cheapest on the street and everybody else is higher than you, what does that do? It gives you pricing power to raise up to those levels and still probably be cheaper for a lot of these items than Target. And that's why you're seeing it's a bigger story here, guys. And I talked about it yesterday, how you're going to see massive separation in companies within industries, which you're not used to seeing. Usually the whole sector goes up and some go up a little bit more than others. You're going to see stocks down 30%, stocks up 30%. And it's key in this market because over the next 2 to 3 years, what's your goal? Your goal is to gain market share. Walmart is gaining market share. Who are the companies that are going to gain market share? Because there's a lot of companies that are going to go under over the next year. A lot of companies are going to see sales go down tremendously. They're going to cut costs dramatically, like Target just announced, right? They're cutting costs. You don't hear that from Walmart. Walmart's like, this is what we're expanding into because things are really good, and they have exposure to gasoline and international sales. Even like that was actually very good for them in China as well. So, Sam Club membership, different memberships. So, very surprised at these numbers at Target. We've had this in our portfolio for a very, very long time and did well with it. This is like the third quarter in a row, though, Daniel, right? I mean, you lowered significantly 2 quarters in a row. This is the third quarter. You thought a lot of this was priced in. It's not priced in, but it goes to show you how you have to be very, very careful of what company you're investing in. And it's not just about, the markets are going to go up 20% or down 20%. It's companies that are going up 20%. Look at what Walmart did yesterday. Look what Target did yesterday, right? These are comparable. These are two companies that you mentioned in the same breath when you're talking about the industry. Lowe's and Home Depot as well. Home Depot I thought was a lot better. Lowe's is doing okay today, and we could turn to that with Lowe's. But you're seeing that separation here, and Target's pretty bad. And again, they have a good balance sheet. They're going to be fine. I think a lot of this is priced in, but when you see Walmart's card, it just makes you want to run to Walmart, even at a much more expensive valuation.
Yeah, I mean, I'm not. It hurts. It's down 15%. If you're a long-term holder in Target, it's basically trading back to the lows where it was in May or June, where it warned, like you said, a couple of quarters ago. It's frustrating. It's a black eye, but I mean, I don't think anybody's really worried about Target over the longer term. I think Target's one of those organizations where if management doesn't figure it out, they'll replace him, I think. I'm not saying his job's at risk or anything of that nature. I'm just, this is tough. They got to weed through all that. They definitely need to follow in the footsteps and get it, execution more quickly than Walmart.